Brad Williams, Frugal Finance, measuring return on investments. Previously, we built a pathway for estimating cost of equity, debt, and capital, and presented an argument that the cost of capital is the minimum acceptable hurdle rate when considering new investments. We also argued that in order for an investment to generate value for a business owner, it must yield a return larger than the most effective way to calculate a project's return in this section. While doing so, we'll try to respond to the following queries. How does one define a project? Specifically, what constitutes an investment and what kinds of decisions do businesses need to make regarding investments? Should we consider the project's cash flows or the accounting earnings when calculating the project's return on investment? How do we account for variations in returns over time if a project's returns are distributed unevenly over time? What is a project? Project analysis looks at which project the company should accept and what it should reject. Accordingly, the question of what makes up a project is central to this. The traditional project reviewed in capital budgeting has three criteria: a large upfront cost, cash flows for a specific time period, and salvage value at the end of the project, which captures the value of the asset of the project. Even though such projects unquestionably form a substantial percentage of project decisions, particularly for construction companies, it would be foolish to think that project analysis stops there. If a project is defined more broadly to include any decisions that result in using the limited capital of a business, then everything from strategic decisions and acquisitions to decisions about which air conditioning system to install in a building would fit within its reach. Defined broadly, then, any of the following decisions would meet the requirement as a project. Key plan decisions to enter new types of construction projects, such as capital construction, constructing a self-storage facility. Acquisition of other companies are projects as well, despite efforts to invent separate sets of rules for them. Decisions on new undertakings within existing businesses or markets. Decisions that may alter the way existing divisions and projects are managed, including new construction projects. Decisions on the best way to deliver an essential service for the business to function profitably. A perfect example would be capital construction's choice of what type of CAD system to buy to allow engineers and construction managers to do their job. Given the CAD system itself generally won't generate revenues and profit, it is an absolute must for other revenue generating projects. Hurdle rates for companies versus hurdle rates for projects. In the previous section, we developed a way to calculate the cost of equity and capital for companies. In this section, we will broaden this decision to hurdle rates in the context of new or individual projects. Using the company's hurdle rate for individual projects, and we use the cost of equity and capital that we've calculated for the company for these projects. In some cases we can, but only if all projects made by a company are similar in terms of their risk exposure. As a company's projects become more diverse, the company will no longer be able to use its cost of equity and capital to review these projects. Projects that are riskier have to be reviewed using a higher cost of equity and capital than projects that are safer. In this section, we consider how to estimate projects' cost of equity and capital. Cost of equity for projects and estimating the beta for a project, we will look at three possible outcomes. The first outcome is the one where all the projects considered by a company are identical in their exposure to risk. This plain vanilla approach makes risk assessment simple. The second outcome is one where a company is in many businesses with broad exposure to risk, but projects within each business have the same risk exposure. The third outcome is the most challenging, where each project considered by a company has different risk exposure. Single business, project risk similar with business. When a company works in only a single type of business and all projects within that business share the same risk profile, the company can use its company cost of equity as the cost of equity for the project. Since we determined the cost of equity using a company beta previously, we can use this same beta to calculate the cost of equity for each project the company is currently reviewing. The benefits of this approach is that it does not require a risk estimation prior to every project, providing managers with a fixed target for their project analysis. The approach is limited, though, because it can only be used for companies who work a single line of business and take on the same type of project repeatedly. Multiple business with different risk profiles. Project risk similar within each product. When companies operate in more than one line of business, the risk profiles are likely to be unique across different businesses, making the assumption that projects taken within each business have the same risk characteristics. We can calculate the cost of equity for each business individually and use that cost of equity for all projects within that business. Riskier businesses will have higher costs of equity than safer businesses, and projects taken by riskier business will have to pay these higher costs. Inserting the company's cost of equity on all projects in all business will lead to over-investing in risky businesses because the cost of equity will be set too low, and under-investing in safe businesses because the cost of equity will be set too high. How do we determine the cost of equity for individual businesses? When the evaluation requires using equity betas, we cannot use the traditional regression method in the CAPM because these methods require past prices. Instead, we have to use one of the two methods that we described in other sections. As substitutes to regression betas, bottom-up betas based on other publicly traded companies in the same business, or accounting betas calculated based on the accounting earnings for the division. Instead, we have to use one of two methods that we described in the last section as substitute to regression betas. We have the bottom-up beta based on other publicly traded companies in the same business, or accounting betas calculated based on the accounting earnings for the division. Projects with different risk profiles. One could contend that each project's risk profile is, in fact, unique and that it is inappropriate to use either the company's cost of equity or divisional cost of equity to evaluate projects. Even though this may have some merit, we have to think of the trade-off. Given that small differences in the cost of equity should not make a meaningful difference in our project estimates, we need to judge if the additional benefits of reviewing each project individually is greater than the cost of doing so. When does it make sense to examine a project's risk independently? If a project is large in terms of its capital contribution requirements relative to the company's experience, and the project has a number of unusual risk characters, it would seem right to calculate the cost of equity for this project independently. The only sensible way of determining betas and cost of equity for individual projects is the bottom-up beta approach. Cost of debt. In the previous section, we stated that the cost of debt for a company should explain its default risk. With individual projects, determining the default risk becomes much more complicated. Projects seldom borrow on their own. Most companies borrow money for all the projects that they're undertaking. Financing mix and the cost of capital for the project. From the cost of debt and equity to the cost of capital, we next have to weigh each by their relative proportions in financing. Again, the task is much easier at the company level, where we can use the current market values of debt and equity to arrive at these weights. We may borrow money to fund a project, but it is often not clear whether we're using the debt capacity of the project or the company's debt capacity. The answer to this problem will again change depending on the conditions we face. When we are establishing the financing weight for small projects that do not involve the company's debt capacity, the financing weights should be those of the companies before the project. When determining the financing weights of large projects with risk characteristics in common from that of the company, we have to be more careful. Employing the company's financing mix to determine the cost of capital for these projects can be wrong, because the project being reviewed could be riskier than the company as a whole and thus unable to carry the company's debt ratio. In this case, we would press for the use of the average debt ratio of the other company in the business in calculating the cost of capital of the project. When it comes to standalone projects big enough to issue their own debt, financing weights ought to be determined by the amounts that the project actually borrows. The financing weights and debt costs related to these products may vary. In summary, the cost of debt and debt ratio for a project will show the size of the project relative to the company and its risk profile, again, relative to the company. Worksheet 11 summarizes our analysis. Project characteristic. Project is small and has cash flow characteristics similar to the company. Cost of debt, company's cost of debt. Debt ratio, company's debt ratio. Project is large and has cash flow characteristics different from the company. Cost of debt of comparable companies if non-recourse debt, or the company if backed by the company's creditworthiness. Debt ratio, average debt ratio of comparable companies. Standalone project, cost of debt for project based on actual or synthetic ratings. Debt ratio for project. Estimating hurdle rates for individual projects. Using the estimation approach that we just laid out, we can calculate the hurdle rates for the project that we are reviewing in this section. Capital construction of a self-storage facility. Because the beta and cost of equity that we calculate for capital construction as a company explain its status as a construction company, we will recalculate the beta for this project by looking at publicly traded construction material retailers. The unlevered total beta for construction material retailers is 2.769, and we imagine that this project will be funded with the same mix of debt. 25% debt to capital, 25%. That capital construction uses in the rest of the business. We will imagine that capital construction's tax rate to be 25% and a pre-tax cost of debt 6.99 applied to this project. Levered beta 2.769 up here times 1.11 minus the tax rate times our debt level equals 329. Levered beta, we're adding leverage. Cost of equity 1.29. That would be the risk-free rate, plus 3.29. That would be the premium because it is a small business, the lack of diversification, times the implied risk premium equals 15.4547. The cost of capital is going to be 1545 times our equity to debt ratio plus 6.99, our cost of debt, times 1.025, which this computes our after-tax cost of debt, times our debt level equals 12.9%. This is much higher than the industry average cost of capital we computed previously, but it shows a higher risk of small privately owned construction business. From accounting earnings to cash flow, the three variables outlined may cause accounting earnings to change significantly from the cash flow. To get from after-tax operating earnings, which measures the earnings to the company, to cash flow to all investors in the company, we have to include in the operating earnings the total of all non-cash expenses, including amortization and depreciation. To remove any and all outflows of cash that correspond to capital cost. Adjust for variations in accounts payable, inventory, and receivables to determine the net effect of these non-cash working capital changes. The change will result in a decrease in cash flow if non-cash working capital increases, while an inflow of cash will occur if it decreases. In the first two adjustments, operating earnings are modified to reflect the division made by accountants between operating, financing, and capital expenditures. In the final adjustment, accrual revenue and expenses are converted to cash. Cash flow to company equals earnings before interest and taxes, 1 minus T, plus depreciation and amortization, minus change in non-cash working capital, minus capital expenditures. The cash flow to the company is a pre-debt, after-tax cash flow that measures the cash generated by a project for all claim holders in the company after reinvestment needs have been met. To get from net income, which measures the earnings of equity investors in the company, the cash flows to equity investor requires To get from net income, which measures the earnings of equity investors in the company, to cash flow to equity investors requires the added step of looking at the net cash flow created by repaying old debt and taking on new debt. The difference between new debt issues and debt repayment is called the net debt, and it must be added back to arrive at cash flows to equity. Also, other cash flows to non-equity claim holders in the company, such as preferred dividends, have to be netted from cash flows. Cash flow to equity equals net income plus depreciation and amortization minus change in non-cash working capital minus CapEx plus new debt minus debt repayments minus preferred dividends. The cash flow to equity measures the cash generated by a project for equity investors in the company after tax, debt payments, and reinvestment needs. Estimating cash flows, capital construction, as described earlier. Capital construction is considering construction of a small self-storage facility. The typical owner equity requirement to complete the one-year project, including all labor and materials, is 75% of cost. The remaining 25% is from debt. For simplicity, there's no depreciation, no CapEx, no working capital, no salvage. The owner will pay capital construction 3 times based on the approved project completions. 25% at the end of the month 5, 25% at the end of month 9, and 50% at the end of month 12. The total cost of the project is 94.69% of the $3.5 million contract with operating margin of 5.31%. The tax on income is expected to be 25%, which is also the marginal tax rate for capital construction. Based on this information, we calculate the operating income for capital construction in worksheet 1.12. We just have this cash flow, so we have a negative 497, 497, 497, 497, 377. If you add that up, what is that going to be, 1 point some odd million? So capital construction has to dig deep. That's expensive. Having that burden, they are responsible for this cost until the owner pays them. They're going to have some interest expense and some other costs related to a line of credit or what have you in order to facilitate this requirement. To get from operating income cash flows, we normally add back the depreciation charge and subtract out the working capital requirements, which are the change in working capital from month to month. In worksheet 1.13, we're ignoring that here. Instead, we include the construction costs over the 12-month period, including interest, cash outflows, and cash inflows from the owner, along with the payback of contractor equity subtracted from total project capital and increases in short-term debt. Here's our after-tax cash flow. You can see that we would want to determine the net present value of this and then our internal rate of return. Maybe we'll do that next. Brad Williams, Frugal Finance, more to come.